Hey everybody, it's Eric with Low VA Rates. Today we are talking about cash out refinances. This is part 4 of a series we're doing on sample savings for consolidating your debt through a VA cash out refinance. So in our last video, we talked about how the simple interest model of mortgage debt is so much better than the compounding variable interest of credit card debt. But today I want to put my money, actually it's not really my money, but I want to put the money where my mouth is and show you actual numbers and back up the claims that I've been making. Okay, now don't forget, it is a wonderful Red Friday. That's why I'm wearing this Red Friday swag. You can get your own if you'd like, but if you have anything red, please wear it every Friday. And speaking of Friday, and speaking of the color red, down there in the right corner of your screen, you should see a bright red subscribe or like button. Please follow along on all of our different social channels. We'd love to stay more in touch with you. So here we go. Before I dive into this, all these calculations, you can kind of get a little preview of what's going on behind me. I want to start with some simple numbers, which, as referred to, are right here behind me, and we're going to walk through those today. So on the mortgage side, this is an example. Let's just assume it's your mortgage. It's an average mortgage with veterans that we work with. Your original loan balance was $225,000. Somewhere in the last year or two, you secured one of those extremely low interest rates down below the 3 range. So you're sitting at a nice, pretty 2.5% fixed interest rate. You've paid your balance down. You would have to have been in the loan for more than 2 years, quite frankly, or you would have had to have paid extra principal. But we're just going to assume somehow you've gotten your balance down to $200,000. So you've made some good progress. Your current principal and interest payment, not talking about taxes or insurance, would be $890 a month in this example scenario. Now, if you're like most veterans, if you're like myself and everybody else in this amazing country we live in, you probably have some other debt. Not everyone, but most of us do. So let's start with some, relatively conservative numbers that we have brought down below the national average. Now, why do I tell you that? Because if you're thinking, oh man, I got way worse debt than that, or my payments are way higher, I'm trying to give you an example that is a bit conservative so that you can see if you're in a worse situation than this, then everything I talk about today is going to be even more impactful and better for you. So let's talk about credit card. This CC here, that stands for credit card. Let's assume in this example, you're carrying $20,000 in credit card debt. Average interest rate of around 16%, though credit card rates are much higher than that. You can probably afford around $400 a month towards your credit card payment. Now, that doesn't mean that's your minimum required payment. It's probably less than this. We're giving you the benefit of the doubt that you don't just make the minimum payment every month. Some people do. Now, we've all heard, no matter what news station we watch, in the last few years, there's this big debate about student debt. We know that many of our veterans carry student debt. So student loan for $15,000. Student debt comes with a relatively decent interest rate, so we chose 6%, which would put you right around monthly payments of $200 a month. Let's move on to autos. Most homes have more than one car, but if you're carrying a $15,000 balance on your car loan at a 2.99% interest rate, car loans are usually 5 or 6 year term, we came up with around $270 a month for your car payment. So if you add the $400, the $200, and the $270, you're going to have about $870 a month on top of your mortgage payment that you have to throw out every single month to some creditor. Total debt that you're carrying, in addition to your mortgage debt, is $50,000. So those are some sample assumptions there. Now I want you to note one thing. These debt numbers, as I've mentioned, conservative. We're not inflating anything. If anything, we're deflating them a little bit for our example. Most Americans out there have much more than $15,000 of student debt, for example. Now, we decided to lowball or be conservative on these numbers so that you will get a very good idea of the impact that a cash-out refinance can have even on smaller amounts of debt. So let me illustrate this point. We're going to crunch some of these numbers for 2 different scenarios. In the first, I'm going to show you what it's like if you don't do anything. Basically, we hear people talking all the time. They say, hey, Eric, I'm at a 2.5% interest rate on my mortgage, and to do this cash-out refinance, I'm likely going to have to give up that rate for a higher rate. So I'm just going to stay put. So let's talk about this first scenario and see what things look like over the next 10 years if you do not do a cash-out refinance. Now, to keep this easy, We're just going to round all of the numbers to the closest 100. So that means in 10 years, you will have paid, get this, $106,800 of total principal and interest payments on your mortgage. It's almost $110,000. Now to get that number, we multiplied your $890 P&I payment times 12, because there's 12 payments in a year, times 10, or simply put 120 payments like this. Now, if you continued paying $400 a month on your credit card like you are now, you'd be able to pay off the full $20,000 in 7 years. So congratulations, it didn't even take you the full 10 years to get out of credit card debt. In that time, you will have paid out around $13,200 in interest on your credit card debt. That means the total amount that you've paid, which is the balance plus all the interest, is $33,200. That's gone out of your bank account over the last 10 years just towards your credit card debt. Now, with that $200 monthly payment on your $15,000 of student debt, you're going to be able to pay your student debt off in about 8 years. So again, another congratulations. It didn't take you the full 10 years, but in that time, you will have put out about $3,900 in interest just on your student debt alone. So the total amount that you've paid on that student debt would be the balance of $15,000 plus the $3,900 in interest, almost $20,000. It's $18,900 that you will have paid out on student loan debt. Now let's go to that $270 car payment. If you took the full 5 years, didn't pay any extra, you will have paid $1,200 in interest. See, that's where the banks make their money. You've paid the bank $1,200 in interest plus the $15,000 balance that you borrowed. That's $16,200 out over the last 5 years to get your car loan paid off. So if you add all of these amounts to your total mortgage principal and interest payment that we talked about, $890 a month or $106,800 over 10 years, you will have paid out $175,000. It's actually $175,100, but I'm just going to round it to $175 if you do nothing. The next 10 years of your life for your mortgage and these three debts will have cost you almost $200,000. Now, let's also calculate the monthly cost you'll be paying during those 10 years. As I mentioned, for the first 5 years until your car's paid off, you'll be paying a total of $1,770 per month. That's $900 a month for your mortgage payment. I round it up a little bit. And $870 a month for all these other loans. So after 5 years, your monthly payment total would drop by $1,500. Why? Well, your car payment falls off and some of the other things that we talked about. After that, 3 more years goes by, your student loan is paid off, and your monthly payment will drop to $1,300 for the final 2 years of this 10-year period that we're trying to illustrate. Now, whether you wrote those down, if you need to hear them again, just rewind this video, write them down, or just keep them in mind, because scenario 2 is where the real power comes in. And that's when we harness the power of the cash out refi. Okay, this is assuming over here, this is where I get to write a little bit today. If you do what I'm going to suggest you really look into, and that is a VA cash out. So I want to start first, understand you will be refinancing this mortgage over here. So I'm going to have to add a few more numbers to the whiteboard. Let's just say at the time that you're trying to refinance, your home's value, so home value, I don't write as pretty as the person that started out over here, $250,000 is what your home is now worth, okay? We're going to refinance your new loan all the way up to your home's value. That's one of the massive benefits of the VA cash out. You can borrow, as we've mentioned in other videos, 100% of your home's value. So, new mortgage, okay, $250K. That's what you're going to borrow. New interest rate, okay? New rate, we're going to put you at 3.25. Now, I'm not afraid to highlight something that a lot of you guys get nervous about. That is, your balance went from $200,000 over here, I hope you can see me, to $250,000, and your interest rate went from 2.5 to 3.25. That's where we start hearing people all the time saying, I don't want to mess with my mortgage. That's why we showed you scenario 1. Now, I want to note, this is just an example Doesn't mean your rate's going to go to 3.25. Might go to 4%. Might actually only go to 2.5. However, the increase will depend on things that impact mortgage rates, the current market, your FICO score, that sort of stuff. So I'm just using examples. In this scenario, if you do this loan, here's how it's going to break down or impact you over the same 10-year period. Because your old loan balance was $200,000 and your home is now worth the $250,000, that means you're going to pull out, okay, your cash out amount is the full $50,000. That's the equity that you can access. Okay, you then use that $50,000 to pay off the $20,000 in credit card debt, the $15,000 in student loans, and the $15,000 in the car loan. Okay, that adds up to, guess what? $50,000. We're taking care of these three debts. Now, the actual payoff amounts might be slightly higher. They might be slightly lower. It just depends. Again, it's an example. I have to say that a few times throughout these videos because the mortgage industry has lots of compliance with it. These are examples. Okay, this now leaves you with one single debt, and that is this $250,000 mortgage. Everything else is wiped out. Now, because both the loan balance and the interest rate are higher, as I've mentioned, your new P&I, okay, P&I is the principal and interest portion of your payment, goes to $1,100 a month. Okay, that's higher than $890. But here's the cool thing. Even though the cash out refinance causes your mortgage payment to increase by $200, over the next 10 years, you actually end up paying only $132,000. I'm going to say total payout. Okay, that's between 10 years worth of mortgage payments at the higher interest and the higher balance. And we're going to compare that to this $175,000 if you do nothing. Okay, so simply by taking advantage of your hard-earned VA loan benefits and cashing out, not only does life get so much easier with one payment a month as trying to balance 3, 4, even 10 in certain situations, you now have saved yourself $40,000 in interest. It's awesome. Conservative example. We see people saving lots more than that, but $40,000 is a heck of a lot of money. So let's look at how much you save on a monthly basis by comparing your new monthly payment of $1,100 to the payments you are making in this first scenario. I got to kind of dance a little bit today because I'm going back and forth. If you remember, by the way, you guys do not want to see me dance. A team that's in here, let's put me up here dancing sometime just for fun. But if you remember, your total monthly payments for all debts in scenario number 1 was $1,760. I'm just going to say $1,700, right? For the first 5 years before stuff started falling off. It was $1,500 for the next 3 years, and then it was $1,300 for the final 2 years of that 10-year example. Now, if we subtract this new monthly payment from each of these numbers, you'll end up with savings of $670. I like putting savings like this. This is no small amount of money. You'll save $670 every single month for the first 5 years. Okay, it's $400 per month for the following 3 years. And finally, it's $200 per month for the final 2 years of that 10-year period. So I'm going to really focus on the $670 because most of us don't know where we're going to be with our mortgage in year 7, 8, 9, or 10. But no matter what, this is a better scenario right here than staying put where you were, in my opinion. That's a pretty significant amount of extra cash every single year. In the VA Streamline market, which if you guys have been following along with us for the last couple of years, people were begging for $100, $150, $200 a month in savings. $670 is massive, okay? Over the 10-year period, your total monthly savings will have added up to almost $60,000. Roughly $59,400 is what your savings will have been over that 10-year period. Now, what do you think you could do with all that extra money? One idea, I love, investments and I love the market, would be to figure out a way to take this extra $670 a month and don't just go blow it on loading up new credit cards or taking on more car debt. do something smart with it. I can't give you investment advice, but I can give you basic financial advice, and that is take this money and make it work for you. There's all sorts of good investments out there. For example, if you took $400 of this 670 that you now are putting in your pocket every month and just got a fairly standard 6% return over 10 years, you'd end up with an extra $65,000 in the bank at the end of 10 years. So, I mean, you're already saving money. Now you're not just saving money, you're making money. And by the way, if you can't make more than 6% on conservative investments in this market, I'd be surprised. But you never know. Let's stay conservative. We know we just threw out a lot of numbers at you, but hopefully what you've been able to learn from this is one main thing. And that is, yes, your interest rate and your balance will generally, almost always in this market, go up when you do a cash out refinance. Get your head out of, oh my gosh, if my rate goes up or my balance goes up, that's a bad thing. What you're doing here is you're doing what the hedge fund managers, the venture capital guys, the very wealthy people in our country do. You're getting rid of bad debt and you're using good debt to get out of the rat race and get ahead. Way too many people focus on rate and not cash flow and payment savings. So you're going to save thousands and thousands of dollars if you look at the entire picture and do what I'm suggesting you do. Now, if you're interested in seeing how a VA cash out refinance could help your specific situation, all you got to do is pick up the phone and give us a call. Instead of using this example, one of our loan officers is actually going to get real figures from you, crunch them, and show you a bunch of different opportunities that you have, but ultimately, they will show you how much money you could actually save through a VA cash out refinance. Thank you for watching. Make sure you wear red every single Friday. If you need some of our red swag, all you have to do is go back to YouTube, go to the little magnifying glass on our page where you can search and just type in red swag. I got a whole video out there on how we can mail you some of your own. Thanks, guys.